$2.42 for a barrel.
Another rise in crude supplies, that'll do it for you, folks. Well, when it comes to spreading out the risk, are standard mutual funds the answer, or are exchange-traded funds a better bet? Jim Lowell, editor-in-chief of the Fidelity Investor, is with us, and Tom Lydon, the editor of ETF Trends, joining us both now. I think I'm going to start with Tom on the ETF side of this, Tom Lydon, because right now, according to the Financial Times, about 6% of investments globally right now are sitting in ETFs. But HSBC is now making a big bet, and they're starting an entire new department over in London that will completely market ETFs. They believe that is where the growth is going to be for individual money. Why is that?
Absolutely, Cheryl. ETFs aren't a fad. They're here to stay, and for a number of reasons. Number one, they're a fraction of the cost of the average mutual fund. They're liquid. You can buy them in the morning, sell them in the afternoon. They're transparent. You understand and know what the underlying holdings represent, and you have so many choices. But the biggest reason is they're tax efficient. Very, very few send off annual capital gains distributions, and as a mutual fund shareholder, that's one of the biggest detriments to fund shareholders, because they're always kicking out capital gains, even in down years like we've seen in the last couple of years.
Yeah, but Jim, I mean, and first of all, I'll preface it with, so that we don't get into the big debate here, I like ETFs for my own portfolio. I agree with everything Tom said. But when we're talking to the average investor out there, one of the things the average investor doesn't do well is pay attention to their investments. And so ETFs seem to me to be more volatile, where a mutual fund generally is you're hiring somebody to manage the money for you.
Tom, I think that's an excellent point. And to Tom's point about tax efficiency, after the cataclysmic fall-off in the markets last year, it'll be hard to find an active manager who doesn't know how to basically offset gains with losses for many years to come. So I think the tax efficiency argument's basically a wash. It is important to note that most people are savers, not investors, not traders. And so the argument for ETFs, namely that they're trading flexible instruments, basically does serve a constituency very well, but I don't think the broad public, especially when you understand that even if you give Jack Bogle his due and say 80% of active managers underperform their benchmark, that still leaves 20% that consistently do. That's nearly 2,000 managers out there who have a long-term career track record of being able to best the benchmark that the ETF is tagged to.
But Tom, isn't it true, though, that overall that most mutual fund managers cannot consistently beat their benchmarks?
That's absolutely right, and that's kind of what Jim just said. And the bottom line is there's some rock star managers or fund complexes who have their claim to fame. They have their 15 minutes or, let's say, 3 years where they're on top of the list. And inevitably what happens is that's when the fund company markets it hard, and that's when the majority of the cash comes into that fund. Inevitably, the majority of the shareholders end up not participating during those great years and end up being there for the flat time or the time when it's underperforming. I'll tell you, even Fidelity Magellan Fund, 62% of its competitors outperformed Fidelity Magellan Fund in the last 10 years. And there's tens of billions of dollars.
Tom, I'll give you that too, absolutely. Tom, I'll give you that, but if you're going to use Magellan as basically the whipping boy here, don't forget that if you'd put $10,000 into Magellan as a truly long-term investor during its inception, during the last Great Depression, 1939, that's when it launched, that $10,000 would be worth north of $14 million today. For a long-term investor, even in a fund that has had a checkered recent performance history, that's pretty good return on the investment.
Gentlemen, though, I was not in the market, though, in 1939. I'm in the market in 2009. I just want to point that out.
Yeah, but you're going to be, Cheryl, you'll be in the market for the next 30 years. So the key question is, how are you going to allocate your assets? And I would say, and Tom knows this well, you need 2 oars in the water in order to row straight. And I think that there's a little bit of a feint in this argument. I like both ETFs and actively managed mutual funds. I think they complement each other very well. But in the hands of an individual who's really geared towards saving, not towards investing, I think being able to have an active manager doing your bidding and your asking makes a lot of sense.
Everybody's being too nice here, Tom. I gotta be honest with you. And I want to talk. I'm talking to my co-anchor because the fees. You and I were talking about this morning.
Right.
That it's the fees. If you have a mutual fund, it's some guy you're paying for his golf membership at the country club.
Well,
it's 1.57%.
Yes.
Is the average annual fee.
What is it?
For 1.57%
Okay, all right,
is the
yeah.
average. It's less than 1% for an ETF. So you're saving. This is my money, my hard-earned money. That if I put into an ETF, I save 1% in an ETF.
No,
and I don't want
because
to paying it to dude.
here's what's
who
going to
may
happen.
lose my money.
You're going to trade that ETF back and forth, and by the time you're done with your fees, you're going to be far north of what the mutual fund was that you stayed in. But I go back
Tom,
to
I've got to disagree there. You know, ETFs are good trading vehicles, but just because you buy them doesn't mean you need to trade them. They're great long-term investments.
No, I know, but you probably will. But what's the difference, Tom, between an ETF and the old unit investment trust, where you just put the investments in a can, investors bought it and sat back, and you couldn't do anything with it. You couldn't change anything in that fund.
Well, again, if the point is that 8 to 9 out of 10 active fund managers underperform the market over time or underperform their benchmark,
what do you think the
why not
individual's
just buy the
performance is
market?
going to be? What do you think they're going to do? Do you think they're going to outperform the individual trying to trade ETFs?
If you just buy the index and the point is you don't have to trade them. You can own them for a long period of time. I mean, there's some of these ETFs that have been around. Well, no, they're not. They're in line with the underlying index. Some of the ETFs that I'm recommending here, for example, the IWM, which is the Russell 2000. That's a great mixed index, and if you held that over an extended period of time, for example, the last 10 years, you'd have handsomely outperformed the S&P.
We got to leave it there, but thank you both very much. And I think I agree with Jim on the little bit of both, probably.
I think Jim agrees with Tom more than he wants to admit, actually. Tom.
Absolutely, I do.
All
right,
right,
gentlemen.
Jim Lowell, Tom Lydon. Guys,
Thanks.
thank you very much. Mike Santoli
Thanks,
so
folks.
quiet tonight.